Hello, it's lovely to have you here again. This is the first part of the beginner's level. So, introduction into forex trading. What is forex trading? Forex trading is also known as foreign exchange. That is the combination of forex, foreign exchange. Alright, that forex, the four means foreign and the X means exchange. Alright, it's as simple as that. Foreign exchange, also known as foreign exchange trading, is the buying and selling of currencies with the aim of making a profit. And that's a basic example. Right now that everybody has access to be able to trade electronically, the basic reasons why everybody started trading is just to make money. Right? That's just the basic, simple thing. Forex trading is the buying and selling of currencies with the aim of making profits. It's just a simple analysis. That's just it. The forex market is the largest financial market in the world, where currencies from different countries are exchanged against each other. Right? Just like saying you are changing your US dollars to Naira, you've just done forex trading because you are exchanging another currency for another currency, a currency for another currency. That's just the whole thing of the financial market. So the history of the forex market. Now some things are very important to know, but then they are just there. But you just need to know them. Just I like to keep it very short and brief. Don't like to bore you with it. Now, forex trading started with gold-backed currencies, moved through the US dollar-based Bretton Woods system, and today is a global 24-hour market where anyone can trade currencies online. I mean, it's just the whole history because everything started from a place before it eventually evolved. So the forex market started from a particular place. Forex trading started from a particular place before we now finally have access to it. Now, if it was like several years ago, nobody would be thinking of open on their phone to place a particular trade or with 5 contracts or something. So this is like a more detailed breakdown of the history. Now, before 1944, the gold standard, currencies were tied to gold. Exchange rates were fixed, and that was just it. Everybody knew the exchange rates. You could go, maybe like you live for 3 months. You just know that the rate would. Let's assume the rate was 1.5 at that moment. You know that the rate would still be 1.5. Right? Just know that the exchanges rate were fixed, and you didn't have to bother about currencies fluctuating because of liquidity or something. Now, 1944 to 1971. That was when the Bretton Woods system came into place. Now, the US dollar at this time became the main reserve currency pegged to gold. There has always been a reason why the US dollar has been a very, should I say a very odd bend? But then the US dollar has been a primary currency from a very long time. So the US dollar became the main reserve currency pegged to gold. Other currencies pegged to the dollar. Now, believe me, I'm not even gonna cap. Before I started trading, I also just learned from somebody as well. So this history, I was not there. I was not born, but I just have a brief overview of it. So I don't just like to dive into it. I don't just like to be capping a lot. If you really want to know more about the history of forex system, you just want to know it, you want to write about it, you want to submit it to your lecturer or something, go to the internet, please. Now, from 1971 to I think 1980, that was when floating exchange rates came. So the Bretton Woods system that was being used before then collapsed, and currencies began to float freely. Right? So somebody lost their house, so they became homeless, something like that. But then you get the gist. Now, from 1980s to 2000, now technology became advanced. Right? The technology that allowed banks and investors to trade currencies electronically. Then you'd have to be an investor, because if you had money, you have to give it to a bank to be able to trade. Firms were there in companies that would help investors to trade. Unlike from then, that was the 2000 till date. Retail forex trading. That's when you and I now have access. You don't need to have a proper document with this and this, where you can have to give it to this to be able to trade. You can just open your phone and place a trade with 10 contracts or something. Right? So individual traders can trade online. The market is global and it's 24/7 and is highly liquid. Now, while writing or putting together this course, I highlighted words that sounded significant to me. So I would like to focus on the words that are actually been holding out. So the forex market is open 24 hours just for 5 days, Monday to Friday. It's not open Saturday. It's not open Sunday. So it opens 10 p.m. or 11 p.m. Sunday, and then it closes 10 p.m., 11 p.m. Friday. So just 24 hours for 5 days, and it's highly liquid. That means it's highly volatile. So why is the forex exchange market traded? Just like we discussed in the definition, the number one reason that your mind will go to is to make profit. That's to make money. Traders buy a currency, they expect will increase in value. Sell a currency, they expect will decrease in value. Right? So it's that simple. Let's say you bought Bitcoin at 50k, and you are having this predicted probability that Bitcoin will go to like 70k or more. So like, let's assume Bitcoin gets to 70k. So you've made some profits. So you withdraw, right? You take your profit out because you just bought a currency that you expect will increase in value. That's just it. Bitcoin is not a currency actually, just a crypto stuff. But then you get the analysis. Same thing with something that it will decrease. You know that this particular currency or coin is going to dang down the drain. You just sell it, alright, before you lose more than you can imagine. So to facilitate international trade and investment, company trading goods and services internationally need to exchange currencies. Let's assume I was exporting some of my things to the United States. Maybe I had a company, I had a product. Now, for it to pass the US check or custom, I think we call them custom here in Nigeria. So I have to pay some money. I don't know how it works, but I know that you don't just import and export things freely. There are tariffs, alright, that cover it and everything. Maybe a 5%, 10%, depend on whatever the currency, depend on whatever tariffs was charged to that country against the country that it's been imported to. But then you get it. So that you would have to like convert your money for. You just need to have that. Let's assume you were a Nigerian, so you need to have dollar, and to have dollar, you need to convert your own naira to dollar. That's forex trading. Now, to hedge against currency risk, businesses and investors use forex to protect themselves against losses due to fluctuating exchange rate. Now, since rates are now like dabbling from year to year, so businesses and investors they use that one as protection for themselves. When they are able to like swap, let's assume the US dollar is now dumping, alright, and gold is stable, gold is rising. So investors and some other business just pack all their money that is in USD and they just put it to gold, right? Because they don't want to lose. So because imagine the US dollar was tanking, that means if your money was there, your money too will be tanking at that time, and investors don't like it when their money tanks. So to facilitate tourism or remittances, people traveling or sending money abroad exchange currencies through the forex market. So you have a sugar daddy and he's trying to send you a couple of bucks, so you would have to convert his USD to NGN, so it can get to you. You get that stuff, right? So participants in the forex markets. First one is banks and financial institutions. They're the biggest players, right? They're trading huge amount for themselves and their clients. Banks always have money. That's just it. So they're always trading big bonds. Imagine currency. The reason why they call them big player. Now imagine a coin was moving, because there's money in the coin. I don't know why I keep saying coin, right? But it just seems like the proper way for me to analyze it for you. So let's assume a currency was moving actually, and it was moving, right? It was growing, and I have like a liquid money of, let's say, $6 billion, right? And I put it to sell that particular pair or that particular currency. That's a whole lot of money, right? That's what banks can do. That thing will to shift it, right? My $10 cannot do anything, but you see that 6 billion, whatever it is that they are putting on the line, it will actually move the market because the market is moved by liquidity, and liquidity is equals to money. So that's just it. Now, governments and central banks, they trade currencies to manage their own economies and control exchange rates. That's it. Corporations or companies, businesses trade currencies to pay for imports and exports and international operations. Just like I explained earlier, let's say I was importing or exporting something, I'll have to like pay in the country's currency. So that's how you can get involved in forex market, because you could actually have to be a company or a corporation or a business. Now, retail traders, that's you and I, people like you and me. We trade online to make profits from the currency. You see that's our only job. You cannot tell me that you are opening your phone and you are placing like 6 contracts because you want to pay for export. No. You are trading because you want to make money, and that's just it. Now, hedge funds and investment firms just like prop firms, right? They trade large amounts to earn profits for their investors. That's just it. So those are like the players in forex trading. in forex market actually. So difference between forex and crypto and stock, because they are different markets. Forex deals with currencies. It's highly liquid. That's just it. It's open for 5 days, 24 hours. Crypto, digital coins, very volatile as well. It's open every day of your life. Now stocks, company shares, regulated exchanges, moderate volatility. That's something that attracts me to stock actually. It's just cool, right? If you don't want to like get involved in forex and you're an investor, you see yourself as an investor, and you want to put some money in the market, so you can try stocks. They are good stocks to get involved with. I don't really know much about crypto, but then I think they're good. So this images helps you to see the difference between forex, crypto, and stocks that's been analyzed and properly broken down. Now the thing is that forex has a daily turnover of 7.5 trillion. That hasn't really been particularly stated. I mean, it goes between 7.5 to like 6.5, I guess. So it just fluctuates. I don't know, but people say 6.5. But in other words, I'm not telling you that you can make as much as that amount in $1 trillion in a day. That's to tell you how much goes into the forex market in a day. For the crypto market, it's $100 billion. That's babish. And for the stocks, it's $40 billion. That's babish. But then you get the OGs. So I think that's all for the slide. So yep, I think this brings me to the end of this section again.
I had to add this. That's not the end of the slide actually, so I had to add this. So yeah, we're going to be talking about characteristics of forex market. The first one here is high liquidity. This is highly liquid. It's a market that's highly liquid because there's so much money inside. It's a 24-hour market. It's open every day for 5 working days, 5 days of the week. So there's leverage, all right? It helps you like to make more than you actually can, and you can also lose more than you actually can. Then volatility, you get something similar to high liquidity. There's a decentralized market that means nobody controls it, all right? And it is highly influenced by fundamentals. What Donald Trump says, what's happening in the country, what's affecting global change. Those things affect the forex market. So low transaction costs. There's no there's no cost you a lot. With as low as $10, you can like start trading. Some brokers even allow you as low as 2,000 naira. But I think that's what broker is that? I think Headway we get, but that's just it. So advantages of forex market. The first one here, of course, would be making money because that's the primary goal of stepping into the financial market. Then it is highly liquid, just like to amplify your opportunities to make more money. Then 24-hour trading, just like we said before, 24-hour trading in the sense that what you cannot be busy for the whole 24 hours. So definitely there'll be a time you can spare out that can work for you. Then low capital requirement, just like I explained, with as low as $10 you can start trading. Then leverage opportunities, able to make more than you actually can and losing more than you actually can. Then no central exchange, just like saying that what it's a decentralized market. So disadvantage is high risk. You can lose a lot of money. Losses, that you just have to put that in mind. You will lose money. So emotional pressure, you can get that. Maybe you're trying to make decisions in a momentum environment where things are spiking and moving. So it might be tough for you if you're not very relaxed. Market volatility as well. Then it requires strong discipline and patience because it's very hard for humans to build discipline and patience. So that's why it's under disadvantages. So then forex instruments. The first one is a currency pair which consists of the Euro USD, just various currencies paired together. Then we have metals, that's gold and silver. XA is for gold, SAG is silver. Then index, this one carries the SPF, the stocks. Then we have commodities for crude oil and natural gas. You can just trade anyone, but they are on other different segments. So just so you understand the part. So now I think this is actually the end of this slide.